RMB Nigeria Stockbrokers say they are projecting an operating surplus of 1.7 billion naira for the NGX Group this year and 2.1 billion naira in 2022. According to RMB, the exchange revenue source remains at low risk due to earnings diversification. And I have Usoro Essien, is an equity analyst at RMB Stockbrokers. He joins me now to discuss the report and more. Thank you so much for your time, Usoro, today. But before we get into your projections for the NGX Group, let's first look into your crystal ball and get a sense of what you see playing out in the fourth quarter and how it has performed so far.
Yeah, so thank you very much, Kenneth, for having me. For the fourth quarter, our outlook is that the fourth quarter would be the most bullish quarter for the year. But just like we had said in our half-year market outlook for the year, we expect just about a 16% return for the BOS by full year. So we expect the strongest momentum to come from the fourth quarter, and this is because aside the improving macro backdrop which we are seeing from not only from the last GDP print but also from current rally on crude oil prices, we also have seen some improvements in the technicals in terms of the improved foreign exchange liquidity that is slowly coming back into the market following the Eurobond and SDR borrowings.
All right, now, but let's get into your projections for the NGX Group now. You're saying you're seeing that surplus, operating surplus of about 1.7 billion this year. For you, what's driving this optimism so far?
Well, for the NGX Group, we know clearly that the exchange's core income is really hinged on transaction turnover velocity on the exchange, and that in turn is linked to activity within the economy and the market. Our expectation is that obviously the platform will see, being the equities platform that it currently earns most of its core income from, would see increased transactions in the fourth quarter of the year. And this is because of, one, we feel the increased FX liquidity in the market now will give some foreign portfolio investors some wiggle room to take decisions going into next year, be it exits or some entries. And also looking at the outlook for the alternative asset class, which is fixed income, it is kind of clear that we don't expect to see yields above the 7 to max maybe 8% levels for the rest of the year, given that the FGN has been able to do most of its borrowing from the foreign Eurobond market. So as such, we think that we would see renewed interest from domestics, PFAs and fund managers coming into the BOS, and that will support the core income. And mind you, the exchange is also invested significantly in the fixed income trading platform FMDQ and the clearing platform CSCS. So without just relying on their core income from transactions, they also have good passive income from the investments and returns they get from those other two investments.
But looking at how the NGX Group is also evolving and the initiatives that they have on board coming on, I'd like to get your thoughts on the likely impact. Specifically, I want you to speak on the area of derivative trading and the likely impact you could see this bringing to the market.
Yes, so as we've said, given the premier status of the exchange, it is one of the biggest market development tools that we have today. And over the years, we've had what I would call our vanilla instruments, equities, and some bonds, even though most of the bonds are listed on this exchange, are now traded on the FMDQ. The exchange has seen that the market is ripe now enough for certain level of derivative products, and to that end, they had established a house that is equipped to trade derivatives just like equities are traded on a standardized platform. What these derivatives will do through different forms. On one, we know that derivatives rely on an underlying asset. So in theory, the ability for the market size of that market to grow into multiples of the existing spot market, which is the equity market, is there once that product starts gathering interest. And two, we see it as an opportunity for hedging products, that can help give level of comfort, in coming to play in our equities market. So the derivatives platform, although it's still early days, we believe is the next growth catalyst for the exchange as it brings a new core income line. And we also see derivatives as an alternative for investors that probably just don't want to play on spot or also want to hedge their positions on those spots. So that's the material catalyst that we envisage will change operations in the
quite a lot of optimism there for the derivatives trading there. But in terms of risks, though, what do you foresee for the NGX Group?
Yeah, so in terms of risk, just like any company operating under the sovereign, I would say their risk is really closer to the sovereign's the sovereign risk in terms of one, the economic growth trajectory. Typically, if the economy doesn't do well, you would expect that some of their core income would be impacted. But that being said, some other risks could be slow execution in terms of getting some of their platforms in place and ready to start admitting products for trading. And then finally, there's always the devaluation, further devaluation risk, which could really scare foreign investors because they look at the total value of their portfolios eroding. So those are kind of the risks. In the long term, you could start seeing competitor risk because we know the market is not monopolized, and with the fintech emergence, you could see some, but that's long term. You could see some players that are able to compete, offering similar solutions that the exchange offers today.
All right, now let's get into your outlook for the markets now, away from the NGX as a listed entity on the exchange. Now, let's look at the broader markets now. We're seeing the year-to-date returns currently around 3.7%. Looking as this week is playing out now, what are your projections for the week?
Yeah, so I would prefer the projections for the quarter. For the week, I kind of require too much, rely on too much technicals. We expect for the quarter Q4 for the market to record its best performance vis-a-vis the previous 3 quarters, and we expect the market to close around the 12%, just above 10% yet for the full year. And this is because, as we've said, that the outlook for fixed income yields are benign, and we think that domestic investors in particular will look to cherry pick on equities that can deliver dividend returns significantly higher than the 7% to 8% levels the fixed income market is delivering, just over the 10%. And also the fact that some of these counters, especially if you look at what's happening in the banking space, it does show that they have remained undervalued to their peers. I'm talking about their frontier market peers. And given some of the historic investments that some of these players have made, a materialization of those investments could surprise investors positively in the near term. So we think the markets the equity markets will attract a lot more domestic participation in the last quarter, and that should lift the performance of the overall bourse.
All right, on the 9-month earnings for lenders, for example, we're seeing some trickling already. Stanbic IBTC already in there. We're seeing profit after tax down about 40%. But I'd like you to speak to the expectations for the other earnings, other banks than expected.
Yeah, so it's going to be a mixed basket for those companies. If you look at the outlook that we strongly recommended, UBA and Zenith, we think that they would continue with the positive numbers that we've seen, continued growth in core banking operations, and even though you may see slight declines in foreign exchange trading, we think that overall operating income for those two players will improve year on year, and obviously that's what one of the foundations we used in recommending those counters. For the players like Stanbic that are heavily exposed, in our opinion, slightly over 80% of their assets are exposed to the declining fixed income yields, and hence they are bearing the brunt of the reinvestment risk. Similar case with GTB, you will see a decline in core banking. But for those that are a little more integrated on the fee and commission side, that could help really reduce the impact of the miss in core banking. But we are bullish on the performance of UBA for the third quarter, Zenith for the third quarter, Access and ETI for the third quarter. And also we expect a surprisingly good performance from FBNH.